Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Toby Nangle, Co-Head of Global Asset Allocation and Head of Multi-Asset EMEA. And we're going to discuss some of the key themes driving markets. These include US inflation, interest rates and geopolitical risk. Toby, let's start with the US. Do we see inflation coming through in the region? And if so, where are those inflationary pressures coming from?
Well, inflation over the cycle has really been the dog that hasn't barked. Unemployment's been persistently falling through levels that people have thought were full employment, and still you haven't had the kind of wage pressure that people typically associate with that. And as such, while inflation started to rise towards the end of last year and continued early this year, it's actually starting to fall back down, and we're expecting it to continue to fall over coming months. But with a weaker dollar and with still more jobs growth in the United States, we're expecting over the medium term inflation to be somewhat higher than it is today.
And our central case is for one or two US interest rate rises over the next 12 months. But what could affect that timeline, and how will the Fed approach a QE unwind?
You're quite right that we're looking for 1 to 2 rate hikes, which is a bit less than the Fed, but a bit more than the market. Next month we've got our expectation in line with the market is for quantitative tightening to be announced. So the beginning of the unwind of the Federal Reserve balance sheet, which has been buying securities all this time. Now, Federal Reserve members, the US Central Bank, have been saying this should be like watching paint dry. But so many people associated an expansion of the Federal Reserve balance sheet with higher levels of asset prices. So it's going to be quite interesting to see whether it really is like paint drying or not. We think that probably it will be relatively sedate affair, and as such, as inflation starts to come through, we can get those rate increases that some of which the Fed are planning, but probably not quite as many as the Fed are planning right now.
And shifting the focus to Europe, Mario Draghi has talked of a strengthening and a broadening recovery in the euro area. But against that backdrop of Brexit negotiations, how do you see the Europe story playing out?
The European data has been very strong, actually. It's been strong at the macroeconomic level and also at the firm level, when we have lots of colleagues going out and speaking to firms across the European Union. The data has been overwhelmingly quite positive. And you've got to remember that for a long time it simply hasn't been so positive. And so having a bit more nominal growth coming through, you've got to remember last year the European Union grew stronger than the United States. With a bit more reflation or less disinflation, that makes for a better environment for revenue growth, and with so much operating leverage, or rather sort of relatively fixed costs, that growth in revenue also leads to margins higher, so stronger profitability. Now, unemployment in Europe is actually a lot higher than it is in the UK or the US or Japan. And so there's more scope for stronger economy to persist for a longer period because there's so much excess capacity, which leads to a relatively benign monetary environment. And this is, stars aligned from an asset allocator's perspective, a really good period to be involved in European assets as that European strength can persist.
Okay, and geopolitical risk, of course, remains high. How seriously are you taking the likes of forthcoming elections in Germany or tensions with North Korea?
I mean, North Korea, it's very difficult for investors to really understand what's going on, to be honest. It's one of those risks that it's hard to put into pricing. And things like German election, by contrast, is relatively straightforward. It looks to us as a situation whereby fiscal reform is not really being debated. The migrant issue is not really in focus. Instead, it looks like what will the shape of Merkel's future coalition look like is what at stake there. So not too much policy impact on markets there. North Korea, a bit of a wild card, but it's hard for us to put into prices.
And with all of the above in mind, what's your general outlook for risk assets, and has it changed in recent weeks?
The outlook hasn't really changed in recent weeks for us. While markets have been stronger, that's largely been due to the fact that the earnings environment has been better. If you looked at the way in which the market was rated a year ago, it's largely rated in a similar way today. That is to say, people are paying similar amounts for future profitability, but that profitability is just that much greater. And that's a healthy market rally on the equity side. We're forecasting from the firm level and also from the kind of macroeconomic top-down that relatively good conditions will persist. And while those might be challenged by headwinds in terms of ratings for equities and bond yields rising somewhat in a rising rate environment associated with stronger economic growth, that's still going to be a relatively constructive investment environment for us.
Toby, thanks very much.
Thank you.